It's 6:07 a.m. You stop at the ATM. The screen is on, but it's frozen, not out of service. Not try again? Frozen. Behind you, a line forms. One guy jokes, then he stops, because the next ATM is doing the same thing, and the next. A woman checks her phone, the bank app opens, her balance is there, her money is there, but it won't move. No cash, no transfer, no answers, just a polite sentence. High volume, please wait. That's how the system breaks, not with fire, with silence. And while the sleeping herd argues about politics, the real trigger is already pulling the floor out from under the world. Japan, not Washington, not Wall Street, Japan. Over the last few days, Japan's bond market started to convulse. Not a headline you feel in your bones, until you do. Because Japan is not just another country. Japan is the funding engine, the quiet, invisible credit card the world has been swiping for decades. Cheap yen, borrow, leverage, buy everything else, stocks, bonds, tech, real estate, even the safe stuff your advisor calls conservative. And when that cheap funding gets pulled, when Japan's yields jump, when the yen starts snapping back like a rubber band, global liquidity disappears fast. And the first asset to scream, not the Dow, not Bitcoin, silver. Because silver is the canary, the tiny oxygen tank in the mine. It gasps first. They told you inflation was transitory. They told you bank runs were solved. They told you bonds were risk-free. They lied. They didn't fix the problem. They moved it. They hid it. They wrapped it in paperwork and called it stability. And now Japan just kicked the support beam. Here's the part most people don't understand. This isn't about Japan having problems. This is about Japan being the hinge on the global door. And that door is starting to slam, slowly at first, then all at once. You've seen the movie. The Titanic doesn't flip in 1 second. It tilts, chairs slide, people laugh, then the music stops. That's where we are. Now, I'm going to say something that will make the sleeping herd uncomfortable. Your retirement account is not invested. It's plugged in to a system that requires constant liquidity, like a patient on an IV, and Japan just yanked the IV line. So what actually happened? Plain English. Japan sold the world cheap money for 30 years, near zero rates, endless bond buying. A central bank that acted like a bottomless buyer. At one point, Japan's central bank owned almost half of its own government bond market. Half. Picture that. A referee buying half the tickets to his own game. You don't have a market, you have a stage show, and now the stage crew is packing up. Japan's central bank has been stepping back, reducing purchases, letting yields rise, even hinting it may have to step in if moves get irregular. Translation? They're trying to exit without blowing up the theater, but exits are messy, especially when the building is full. Here's what that shift means. When the biggest buyer steps away, someone else must buy. Pensions, insurance companies, banks, foreign investors. If they don't show up, prices drop. Yields spike, and the world feels it. Because Japan isn't isolated, Japan is wired into everything. U.S. treasuries, global credit, foreign exchange, derivatives. So when Japan coughs, the world catches pneumonia, and you feel it even if you never bought a Japanese bond in your life. You feel it when your local bank raises loan rates overnight, when a 30-year mortgage quote jumps and buyers vanish, when home prices wobble because financing just got more expensive. You feel it inside safe bond funds, the ones retirees were told to park in for stability, because when yields spike, those funds bleed quietly, month after month. While the statement still looks respectable, that's the trick. Losses in bonds don't always look like a crash. They look like a slow leak, a tire losing air while you're still driving. Now, the mechanism they never explain on TV, because it would scare people. It's called the yen carry trade. You borrow yen because it's cheap. You swap it into dollars. You buy something that yields more. You pocket the spread. Sounds boring, sounds safe, until you add the ingredient that makes it lethal. Leverage, 5 times, 10 times, more. This is not grandma's savings account. This is a casino with a banker's face. And the house is built on cheap yen. Now watch what happens when Japan's yields rise. Late January 2026, Japan's super long bond yields surge. 40-year yields push into record territory around 2%. 10-year yields surge too, around 2%. 26%, levels Japan hasn't seen since the late 1990s. That's not a number. That's pressure. And it didn't happen in a vacuum. Politics lit the match, a snap election. Talk of suspending an 8% consumption tax on food for 2 years. Estimated cost? About 25 trillion. Translation? More borrowing, more bonds, more stress. So investors did what they always do when they smell debt. They ran. They dumped bonds. Liquidity got ugly, record ugly. A buyer's strike. And a buyer's strike is the scariest phrase in finance because it means the market is open, but no one is really there. Like a grocery store with empty shelves, lights on, doors unlocked. But the food is gone, so yields shoot up. And when yields shoot up, the carry trade becomes a trap. Carry trades are not built for volatility. They're built for calm. Japan has been the calm anchor for decades. Now it's not calm. Now it moves. Now it bites. Here's the math part, the part they avoid, because math exposes the lie. You borrow the equivalent of $1,000 in yen. You lever it 10 to 1, so you control $10,000 in assets. Now the yen strengthens 5%, just 5%, not 50, 5. What happens? That 5% move hits your funding side. It's like your house suddenly costs 5% more overnight, but your income didn't change. Only the ground under you did. And you're leveraged, so your equity gets hammered. That 5% can turn into a 50% wipeout on the capital you actually put up. That's why carry trades don't slowly unwind. And they snap. They break. They unwind in a stampede. Now the second math problem, bond math. The kind that punishes retirees who played it safe. When rates rise, bond prices fall. That's not opinion, that's arithmetic. On long bonds, small rate moves create big losses. A 1% rise can mean a double-digit price hit on long-duration bonds. Now add leverage inside the system. Banks, funds, derivatives. It becomes a cliff. And here's where the trap tightens. When margin calls hit, everything gets sold. Not because it's bad, because it's liquid. The system sells what it can, to cover what it must. Your diversified portfolio becomes one giant fire sale. And this is where silver enters like a siren. Silver is liquid. Silver is tradable. Silver has futures. Silver gets hit by forced selling. So yes, silver can drop first. But silver has something stocks don't have, monetary memory. When trust dies, people run to what they can hold. And silver is the everyman's hard asset. Small enough to buy, portable, recognizable, tradable. So in a liquidity shock, silver can do something that confuses people. It can fall and then surge. Why? Because first comes forced liquidation, then comes panic hedging, then comes physical demand. Paper gets slammed. Physical gets scarce. And when physical gets scarce, the spread opens. Delivery delays appear. Premiums rise. And the truth peeks through the curtain. Now, there's a question I want you to ask yourself. If the system is safe, why do they need so many guarantees? FDIC, backstops, emergency programs. Listen carefully. The FDIC is not a magic wand. It's a fund. And the size of that fund matters. As of late 2025, the FDIC's deposit insurance fund was about $150 billion. That reserve ratio was around 1, 40%. Translation? About 4 cents of insurance money for every insured dollar. That's not a fortress. That's a raincoat in a hurricane. In a real liquidity shock, the problem isn't ownership. The problem is movement. You can own money you can't touch. And when panic hits, the government's favorite move is not to save you, is to save the system. They will prioritize the plumbing, not your kitchen. Guarantees become paperwork. Paperwork becomes delays. Delays become excuses. And if the government is already drowning in debt, if interest costs are already heavy, if deficits are already baked in, the backstop is just another promise. And promises are what fail first. This isn't a theory. This is math. Now we go to the part nobody likes. When the system cracks, the rules change. Not after the crisis, during it. They don't ask your permission. They declare an emergency. Then the doors close. You already saw a preview in January 2026. Currency rate checks. Talk of coordinated intervention. The yen dropping, then ripping higher on rumors. That whiplash isn't normal. It's stress. Stress in the pipes. And when the pipes shake, the people in charge do two things. First, they try to calm you. Second, they try to control you. Imagine this. You wake up to a temporary bank holiday. 2 days, maybe 3. Your bills don't stop, but withdrawals do. Your mortgage autodrafts anyway. Your insurance autodrafts anyway. Your property tax bill still arrives, but you can't get cash. You can't move money. You can't fix it with a phone call. Then comes the next step. Limits. Maximum withdrawal per day. Maximum transfer per week. Enhanced verification. Fraud protection. They will call it protection. It will feel like a cage. And while you're stuck inside it, prices keep rising. Gas, groceries, medicine, heating. Your lifestyle becomes a negotiation, a rationing system you never voted for. You planned a calm retirement, and suddenly the calm life is a checklist. Did the card work? Did the payment clear? Did the bank lift the limit? Did the store restock? Now they change the language. They always change the language. They stop saying inflation. They start saying price stabilization. They stop saying controls. They start saying fairness. And then they offer the miracle cure, a new system, digital, programmable, safer, a central bank, digital currency, a CBDC, a digital dollar, a digital yen, whatever label they choose. It sounds modern. It sounds clean. But ask yourself one question. If your money is programmable, who holds the remote? Because with programmable money, the same people who caused the problem can manage your behavior. One click, one rule, one temporary restriction. And yes, they will say you can still use cash until you can't. They won't announce it like a villain. They'll do it like a dentist, for your safety, for your convenience, for the good of the system. Now combine that with something older, something darker. History shows that when governments get desperate, they reach for private savings. Not because they want to, because they have to. In 1933, Americans learned that lesson with gold. One executive order, one deadline, one forced exchange. People forgot, or they were never taught, and that's the trap. The sleeping herd believes the system is permanent, that the rules are fixed, that their pension will always buy what it buys today. But you and I both know better. A pension is a promise. A bond is a promise. A bank deposit is a promise. And promises burn? Imagine this. Your pension hits, same number, same date, but it buys half the groceries, half the medicine, half the heating oil. You go to refill a prescription. The pharmacist shrugs. The price went up again. You go to fill the car. The pump stops at an artificial cap. Daily limit reached. You try to pay a contractor for a repair. He says he only takes cash or metal or a payment app that charges you a fee you never agreed to. And your neighbor says, "Why didn't you do something when you had time?" That sentence is a punch, because time is the only asset you can't buy back. This is how retirement gets stolen, not by a thief in a mask, by a policy memo, by a weekend announcement, by a quiet change in terms you never read. Now, the awakened few do something different. They don't chase returns. They reduce dependency. They build lifeboats. And the lifeboat, in a world of paper promises, is a bearer asset. Physical gold, physical silver, not as a trade, not as a chart, as survival, as freedom, as a private reserve you control, because in a liquidity shock, you learn a brutal phrase, counterparty risk. If your wealth is a number on someone else's screen, then your wealth depends on their survival, their honesty, their liquidity, their permission. Banks have counterparty risk. Brokerages have counterparty risk. Pensions have counterparty risk. Even insured accounts have counterparty risk, because access matters as much as ownership. Physical metal is different. It doesn't need a password. It doesn't need a power grid. It doesn't need a banker's approval. It just is. Now, let's get practical. Paper silver is a promise. An ETF share is a claim. A futures contract is a bet inside a clearinghouse. A mining stock is a business with costs, management, and political risk. In calm times, those can track the price. In chaos, they can decouple. Physical is not a claim. Physical is the thing. It's the difference between I own a car, and I own the title to a car that's parked in someone else's garage, and they're closed for the weekend. When liquidity shocks hit, weekends are when they move. Friday afternoon announcements, Sunday night futures gaps, Monday morning limits. That's when the game changes. And that's why silver reacts first. Silver is small. The silver market is tiny compared to stocks and bonds. A small wave becomes a tsunami. Silver also sits at the intersection of fear and function. It's a monetary metal, but it's also used in industry, electronics, solar, medical, data centers. So when the world is choking on debt and also building new infrastructure, silver gets pulled in two directions at the same time. And when liquidity tightens, the paper market gets stressed. Futures, options, margins, forced selling. That's why you can see violent moves. Down hard, then up harder. And here's the truth most channels never say. The price you see on a screen is not always the price you can buy. Screens are paper, counters are physical. In a shock, paper can say one thing while the shop says another. That's when people finally understand premiums. That's when they realize supply isn't a theory, it's a line, a delay, a sold-out sign. Now, sharpen the US versus them line, because it matters. They get bailouts, you get policy adjustments, they get liquidity lines, you get withdrawal limits, they get rescue packages, you get inflation. That's the pattern. And Japan just made it visible. Japan is the world's debt laboratory. Decades of near zero rates, decades of, it's fine. Now yields are rising anyway. And if Japan can't keep the lid on its own pressure cooker, what makes you think anyone else can? So the solution is not panic. The solution is positioning. You don't need to be rich. You need to be early. You need to move before the rules change, before the bank holiday, before the temporary controls, before the next crisis is used as an excuse to build the programmable cage, physical silver, physical gold in your possession, with a plan for storage, a plan for access, a plan for your family. And here's the psychological shift that separates the awakened few from the sleeping herd. Stop thinking like an investor chasing returns. Start thinking like a survivor protecting purchasing power. Because in the next phase, return on investment becomes less important than return of freedom. Imagine the financial system as a row of dominoes, big ones, tall ones, painted with comforting words. Stable, insured, protected, safe. Japan is one of the first dominoes. When it wobbles, the vibration travels across oceans, across markets, across your retirement account, into your daily life. And silver? Silver is the small domino at the front. It tips first, so you notice, so you wake up. That's why we watch it. Because silver doesn't lie politely. It screams, now here's the final choice. And it's simple. You can wait for official confirmation from the same people who denied the problem for years. Or you can act like the awakened few. Position while the exits are still open, while you still have time. If you want to survive what's coming, subscribe to Economy Meets History. Not for entertainment, for preparation. For the signals the mainstream ignores until it's too late. Because the sleeping herd is about to learn a lesson the hard way. And we're not here to be part of the herd. We're here to see it, to prepare. To move, Japan just shook the table. The carry trade is wobbling. Liquidity is vanishing, and silver is already screaming. One last thought. When the lights flicker, you don't argue about the power company. You reach for the flashlight. Be the person with the flashlight.